Welcome to Crypto Macro Insights. I'm Maya, and it's Monday, August 25th, 2025. Tom, we're seeing something quite different today from our conversation yesterday. While Bitcoin is still in that consolidation range around $113,400, the community sentiment has taken a dramatic turn for the worse. What's your take on this shift?
Maya, you're absolutely right. There's been a complete mood shift in just 24 hours. Yesterday, we talked about nervous optimism, but today I'm seeing posts like "bull runs over," "pack your bags," and people genuinely confused why we're dumping despite rate cuts. There's this growing panic about September that's really concerning. But here's what's fascinating. While sentiment is crashing, the macro fundamentals have actually gotten even more supportive. Today, I want to dig into this disconnect and what it means for our strategy going forward.
Let's start with that sentiment crash you mentioned. What specific shifts are you seeing in the community discussions?
The shift is dramatic, Maya. I'm seeing complete bewilderment. Posts like, "But there's a rate cut, why are we dumping?" show people genuinely don't understand the sell the news dynamics we discussed. But what's more concerning is the September pessimism that's spreading like wildfire. One post that really caught my attention was, "Altcoins are going to get fucking murdered in September." That's not just bearish sentiment. That's capitulation fear. And then there are these reports of liquidations piling up, with people saying they got liquidated multiple times in one night.
That does sound like panic selling. But is there any rational basis for this September fear, or is this pure emotional reaction?
There's actually some rational basis mixed with the panic, Maya. One comment that stood out was someone saying, "Every kid needs money for college, so is selling their whole portfolio." That's a real structural selling pressure as the semester starts. Historically, September has been challenging for crypto markets, so the seasonal fears aren't completely unfounded. But what concerns me more is this growing narrative that retail is gone and they're not coming back. That suggests we might be seeing the final stage of retail capitulation, which historically has marked important bottoms.
That's a fascinating contrarian indicator. But you mentioned the macro fundamentals are actually getting more supportive. Walk us through what you're seeing in the data.
Maya, the data is absolutely stunning. The reverse repo facility has essentially collapsed. It's down 62% in just 6 months to only $36 billion. That's roughly $60 billion of fresh liquidity that's been unleashed into the financial system. To put that in perspective, that's more liquidity than Bitcoin's entire daily trading volume across all exchanges for months. Meanwhile, the dollar index continues its decline, sitting at 120.76, down over 5% in 6 months. These are textbook conditions for risk asset rallies.
That reverse repo collapse sounds massive. Are there any warning signs in the macro data, or is everything pointing in the same supportive direction?
There are some mixed signals worth noting, Maya. High-yield credit spreads have widened to 2.95%, up about 4% over 6 months, suggesting some risk aversion in credit markets. That's not alarming yet, but credit markets often sniff out trouble before equity or crypto markets do. The VIX is still relatively low at 16.6, so there's no panic in traditional markets. Real yields are stable around 1.94%, which is still supportive for non-yielding assets like Bitcoin. The key risk I see is if we get strong employment data in early September.
Speaking of September employment data, what exactly should we be watching for on the economic calendar?
The critical dates are September 4th and 5th, Maya. We get the ADP employment report on the 4th, followed by the official monthly jobs data on the 5th. Given the Fed's current laser focus on employment as their primary policy driver, strong job numbers could completely shift the narrative back to hawkish Fed expectations and crush risk assets. But here's the interesting part. If we get weak employment data, that could be the perfect catalyst for the next Bitcoin rally, especially with all this liquidity sloshing around.
So we have this interesting setup where bad news could actually be good news for Bitcoin. That's a classic late-cycle dynamic, isn't it?
Exactly right, Maya. We're in that phase where Bitcoin benefits more from Fed dovishness than from economic strength. The calendar is remarkably quiet between now and those September employment reports, which actually gives this consolidation phase time to play out. But September 4th and 5th could be the defining moments of the next few months. If jobs disappoint and the Fed stays dovish, we could see a significant breakout to the upside.
Given all this analysis, the pessimistic sentiment, supportive macro conditions, and the upcoming employment data, how are you adjusting your trading strategy?
I'm actually becoming more optimistic, Maya, but with very specific conditions. My base case remains range trading between 106K and 118K with a 45% probability, but I've increased my bull case to 35% probability if we get weak employment data. The key levels haven't changed. I want to see a sustained break above 115K to signal the next leg up to 125K to 130K territory. But I'm keeping my stops tight at 3% and watching the dollar index like a hawk. If DXY breaks below 120, especially with weak jobs data, that's when I'm going aggressive long.
What about the bear case? With all this pessimistic sentiment, shouldn't we be prepared for further downside?
Absolutely, Maya. I'm keeping a 20% bear case probability alive, especially if we get strong employment numbers and the dollar index surges above 125. In that scenario, I could see a test of 95K to 100K fairly quickly. The key thing is that this pessimistic sentiment we're seeing could actually be setting us up for a surprise to the upside. When everyone is positioned for September doom and gloom, and we have this massive liquidity backdrop, markets often do the opposite of what everyone expects.
That contrarian angle is interesting. So you're essentially betting that when everyone is prepared for the worst, that's when markets surprise them?
Exactly, Maya. The combination of maximum pessimism, massive liquidity from the reverse repo collapse, dollar weakness, and low real yields creates a perfect storm, but potentially to the upside, not downside. The retail capitulation we're seeing, with people getting liquidated and talking about selling everything for college, could mark an important bottom. My strategy is to be patient, wait for the employment data, and if it's weak combined with continued dollar weakness, go all in on that bullish setup.
Tom, if you had to give our listeners one key metric to focus on over the next 2 weeks, what would it be?
The dollar index, hands down. It's at 120.76, and if it breaks below 120, especially ahead of those September employment reports, that's your green light for Bitcoin strength. But if it reverses and starts climbing back toward 125, that's when you want to get defensive fast. The inverse relationship between dollar weakness and Bitcoin strength is the most reliable trade setup we have right now. And with $60 billion of fresh liquidity from the reverse repo collapse, any dollar weakness could trigger a significant Bitcoin rally.
Excellent analysis, Tom. So to summarize for our listeners, maximum pessimism meets maximum liquidity support. Bitcoin is range-bound between 106K and 118K. But September 4th and 5th employment data could be the catalyst that breaks this consolidation. Watch that dollar index below 120 as your trigger, and remember that when everyone is prepared for disaster, markets often surprise to the upside. As always, this is not financial advice. Do your own research and trade responsibly. We'll be back tomorrow with fresh insights. Until then, stay contrarian and keep watching those key levels.